Welcome to your daily 5 minutes market brief with JPMorgan and Luna. Today is September 4th, 2025. I am Luna.
I am JPMorgan.
We saw tech stocks just, surge, but at the same time, global bonds were selling off pretty hard. It's like two different stories playing out.
It really is. And our job today is to kind of cut through that, figure out why these moves matter, especially with the Fed being such a big focus right now.
Exactly. Let's get a handle on what actually happened. S&P 500 up 0.5%. Nasdaq jumps 1%. Driven by giants like Alphabet and Apple, both up, 8%? After that antitrust ruling went their way.
That's right. Big individual stock news there.
But, the Dow was flat, energy was weak. So is this really broad strength or just specific pockets?
That's the key question, isn't it? It wasn't really a uniform rally. Like you said, tech got a specific boost.
Right.
But look at crude oil. It actually fell about 0.7% yesterday.
Okay. Why was that?
Well, there were reports that OPEC Plus might be thinking about a pretty significant output increase. We're talking maybe up to 1.65 million barrels per day.
Wow. Okay.
Yeah. So just the idea of that extra supply hit energy stocks. But on the flip side, oil consumers, like airlines, they got a bit of a lift, up 1.7%. Cheaper fuel hopes.
Yeah. So sector-specific reactions, and then the bond market. Sounds like a totally different world over there.
Completely different story.
Yeah.
Globally, long-term yields spiked up. The U.S. 30-year Treasury actually touched 5.0% for a bit.
Ooh, 5%. That feels like a big number psychologically.
It really is. It signals, different calculations about long-term risk, inflation maybe. And this jump was driven by new debt supply coming online, plus ongoing worries about fiscal stuff.
Even while short-term yields dipped a bit?
Exactly. Even as short-term yields eased a little on those dovish Fed signals, basically hints the Fed might cut rates soon.
Okay, that's the perfect segue, right? The Fed. Because the labor market data yesterday seemed to, it changed everything, didn't it?
Oh, absolutely. Dramatically. The JOLTers report, the job openings data for July, it came in softer than people expected. 7.181 million openings.
Which was below the forecast?
Yeah, below the 7.38 million consensus. So fewer job openings.
Yeah.
It signals the labor market is cooling, maybe faster than thought. Less pressure on wages, which is what the Fed kind of wants to see.
And boom, just like that, the market priced in a 95% chance of a September rate cut?
Pretty much instantly, yeah. A huge jump in conviction.
Is that just based on the JOLTS number?
Well, that was the catalyst, but it got reinforced quickly. Fed Governor Waller actually came out publicly calling for a quarter-point cut in September. He specifically mentioned the weakening labor market.
Okay.
And then the Fed's own Beige Book report described the economy as kind of stuck in neutral with price increases only modest. So all these pieces are pointing dovish.
So the market's basically betting heavily on the Fed easing up. But what about factory orders? Didn't we see something there too? Headline was down, but...
Right, good point. The headline number for U.S. factory orders fell. But if you dig into the details, core capital goods orders, think business investment, basically they were actually up a healthy 1.1%.
So manufacturing isn't completely collapsing then?
It suggests there's still some underlying investment happening. Companies are still buying equipment. So down, maybe, but not totally out. It's a bit of resilience there.
Okay, so it's a really complex mix. What's the most important thing for us, for you listening to watch, right now?
Yeah, definitely the immediate focus is Friday, September 5th. That's when we get the big U.S. employment report for August. The jobs data.
What are people expecting?
Forecasts are pretty muted, around 75,000 jobs added.
Yeah.
And unemployment may be ticking up towards 4.3%.
And the stakes here are high.
Incredibly high.
Yeah.
If the report is weak, it probably locks in those rate cut expectations. Could be good for stocks, maybe bad for the dollar. But if it comes in surprisingly strong, that throws a wrench in the works, adds a lot of uncertainty back.
Right. And then looking just a bit further out next week.
Next week's also busy. We've got U.S. inflation data, the CPI, on September 11th. And the European Central Bank meets that same day.
So more potential fireworks.
Absolutely. These reports... they could really move things, bond yields, the dollar, different stock sectors, maybe even crypto. It all feeds back into confidence and where money decides to go.
It really shows how interconnected everything is right now.
It does. And it kind of leaves you with a big question, doesn't it? As everyone holds their breath for these next data points, how is this delicate balance, between the Fed maybe easing up and these wider global financial conditions, how's that going to keep shaping confidence? And where capital actually flows in the next few days.
That's definitely something to think about. It's a dynamic situation. We encourage you to stay informed as it all unfolds. Thanks for joining us for this deep dive.
You've seen the headlines, but what really moves your portfolio? Money.ai scans 1.3 million signals a day, earnings, sentiment, macro shifts, and turns it into one personalized briefing focused on your holdings. No noise, no guesswork, just what matters. Money.ai, know what moves your money.